Morning, guys. It's Thursday, July 16th, 5:24 a.m. Central Time. Grain markets are higher this morning. December corn futures up 2.25 at 471 3/4. November soybeans up 3 3/4 at 1205 1/2. September Chicago wheat up 7 at 684 1/2. September Kansas City wheat up 2.25 at 722 1/4. September spring wheat up 1.5 at 684 3/4. Welcome back to Grain Markets and Other Stuff. This is the best grain market show on the planet. My name is Joe, and I'm not wearing a hat today.
Yeah, this is odd.
You know, it was interesting, but the hair and makeup department has been on vacation for like a really long time, and I
Oh,
don't pay them very much, obviously,
yeah.
but they're back. They're back here. So,
Thank
yeah,
goodness.
no hat today. Big change of pace. So, what's going on in Nebraska, Mackenzie?
Oh, it is hot and golly, that's about it. There's not a lot
It's
besides
hot everywhere.
skiing. Yeah, I know it's terrible.
Hey guys, do us a favor. If you're watching on YouTube, hit the subscribe button. We are criminally undersubscribed versus the amount of views that we actually get. And if you're listening on the Apple Podcast app, leave us a quick review. That'd be much appreciated. Okay, we've got to start off with wheat and Russia, Ukraine. This is the big story in the grain markets this week.
So wheat futures surged yesterday amid escalating Russia-Ukraine tensions. The September 26th Chicago wheat contract gained roughly 32 cents to close near 677 per bushel, while the September Kansas City wheat contract climbed 42 cents to 720 per bushel. The rally was driven by news that Ukraine has lost about one-third of its grain export capacity following intensified Russian missile and drone attacks on Black Sea ports. Meanwhile, strength in wheat futures spilled over into the corn and soybean markets, with the December corn contract gaining 9 cents to close near 470 per bushel, and the November soybean contract rising about 11 cents to settle near 1202 per bushel.
Absolute face ripper of a rally in the wheat market. We've had this chart just about every day this week, but it is worth reiterating that Russia and Ukraine combined are projected to account for 29% of all global wheat exports. So if we've really got, what did you say, a third of Ukraine capacity
Yep.
offline and 25% of Russian export capacity potentially being rerouted, this is extremely problematic, and the market is taking no prisoners here. Short covering, speculative buying. Interestingly enough, the private group's estimating that the funds, large speculators, were still net short SRW wheat at yesterday's close. And I don't know if that's reality or not. If it is reality, you could see some more short covering into today and late into the week. Here is the September HRW wheat contract. You're closing in on those highs from back in May. And the rally in May had to do with U.S. drought. We had a pretty severe drought across the U.S. Southern Plains, which is HRW wheat country, winter wheat country, and that helped propel the market higher at that time. At that time, we didn't have the big Russian Ukraine escalation, and we were just trading the drought story. And as it turned out, I think U.S. wheat at that time got a little bit too expensive versus its global competition. Now we're in a situation where, okay, that U.S. drought was reality and the HRW crop in the U.S. was short. And now we've got a couple of our biggest exporters at risk. So the market is creeping back up toward those drought highs that we saw back in May. Here's September SRW wheat, Russia, Ukraine, of course, the story. We got within a few ticks of that $7 per bushel high overnight in this September wheat contract for the SRW. So if you're an SRW wheat grower and you missed the rally and you missed the high last time around, they're giving you another chance here at very similar prices here this morning. Here is spring wheat, which has been the underperformer relative to the other two classes, Russia, Ukraine, and you've also got the heat story. Too much heat in the northern plains, too much heat in Canada. So this wheat thing is very interesting. It's changed very quickly. It's a positive for the row crop markets. Wheat's always, for a long time now, wheat's been kind of like an anchor on row crop prices. So there's a lot of wheat in the world. Wheat prices are low. You know, you can shift out wheat into feed rations in some situations when there's too much of it. And it doesn't help. And when you get wheat to cooperate, it makes a rally in corn and soybeans a little bit easier. This is a longer term wheat chart, and I threw some retracement lines on here just for reference. This is a monthly continuation chart of HRW futures, and the monthly chart actually looks pretty good. If you could close up here this month, and I know we still got a couple weeks left to go, it would look really good. And maybe some of those retracement levels are not totally insane. The 38% retracement of the move from the 2022 high to the 2025 low would be 820 a bushel. The 50% retracement would be 28 per bushel. If this escalation continues and there really is some material export disruption with regard to the Black Sea, those sorts of levels are not crazy at all. To go to the row crops, D's corn looks much better this morning. We're trading above that 469 and a quarter area that we've been talking about for a while. If you could close above that today, I think it would be very positive. I think you could unleash some speculative buying, and who knows, maybe you make another run at $5. We've not only got a higher wheat market, but we've got some heat and some dry weather in the Corn Belt in prime time corn growing season. It's July 16th. This is the time of year that really matters. No beans. Test of 1214 incoming. Yeah, very possible. That was the high back in May. There was some chatter yesterday that U.S. exporters sold 5 or 6 cargoes of new crop U.S. soybeans to Chinese buyers. I would not be surprised to see a flash sale confirming that from USDA later this morning.
House Republicans unveiled a $95 billion spending package on Wednesday, which includes $60 billion for military spending amid the ongoing U.S.-Iran conflict. The proposal also includes $12 billion in farm assistance to help producers offset higher input costs driven by the war. Although prices have somewhat moderated, input costs such as fertilizer and fuel remain elevated after surging in recent months due to shipping disruptions through the Strait of Hormuz. Critics, however, argue that the bill would add more than $100 billion to the national debt over the next decade when interest costs are included.
Look at Mike Johnson in that picture. Doesn't he look happy?
So happy.
Okay, so yeah, money for Iran, whatever. You guys are interested in the farm aid. So $12 billion in probably direct farm payments. If that were realized, and it probably will be realized, I think it's inevitable, unless you see a big shift in market structure or farm profitability structure or lack thereof. I think another round of payments is coming. This would be along the same lines as the $11 billion Farmer Bridge Assistance Program that was approved in 2025 and paid in 2026, and along the same lines as the $10 billion ECAP program, Emergency Commodity Assistance Program, which was approved in 2024 under Joe Biden. And I just want to say that because the comments are going to fill up with, oh, it's Trump bucks, it's Trump bucks. It's not. I mean, it is Trump bucks, but Biden was doing the same stuff. So get off of that. And that was approved in 24, paid in 25. So this all kind of takes us back to, you could talk in circles about this all day long. We did the whole discussion about Brazil versus U.S. input costs. And if you continue to subsidize the U.S. producer to grow crops that don't make money, they're going to have the money to pay up for inputs. And the input suppliers will charge you what the market will bear. And when farmers have more money, the market will bear higher prices, and that's what you're going to pay for them. So do we want to get off this hamster wheel or not? I mean, some of you guys would say yes. I think getting off the hamster wheel would be extremely, extremely painful for a lot of people, and that's why it may not happen.
Excessive heat is raising concerns over U.S. corn yield potential. Parts of the Corn Belt started the growing season excessively wet, leaving some fields more vulnerable to heat stress during pollination. According to the USDA, 34% of the U.S. corn crop is now pollinating. The heat dome, currently centered over the northern plains, is expected to shift southward towards the end of the week. This should bring some relief to the northern Corn Belt while keeping above normal temperatures across much of the central and southern plains and parts of the Corn Belt.
Here is the dome, 500 hectopascal geopotential height and anomaly. Everybody knows what that means.
Yeah.
This is just a way to illustrate what the dome is doing and how the pressure system works. But it's sitting over the northern plains, Canada, parts of the northern Corn Belt. The further south you go, the less intense it is. Let's look at some month-to-date weather stuff from our friends at Crop Profit. We'll do both temperature and rainfall. If you guys are sitting on a commercial grain desk, or you're on a fund desk and you're trading grains and you're looking at weather, you should absolutely buy Crop Profit. It's absolutely fantastic. I look at it every single day, and I just do a podcast, and we show you guys kind of the basic map. They've got a lot more like complicated stuff. In any case, based on Crop Profit data, U.S. corn areas have averaged 3.6 degrees above normal so far July month to date, and that historically is pretty damn warm. Premium subs, we did a video on Thursday last week where we ran through temperatures versus corn yield and how all that stuff plays out as it relates to the month of July. Precipitation, we've been just fine. U.S. corn areas have seen 111% of normal rainfall so far during the month of July. So the concern is not precipitation or drought. The concern as it relates to weather is heat. And I think it's a lot more difficult for the market and for everybody really to figure out if heat is a problem. Drought is always like an obvious problem. If it doesn't rain, it's very obvious on the maps. You can see the drought monitor, you can see it building up. When you get this heat, it's like it's a little bit difficult to identify what sort of problems, if any, are going to emerge as it relates to crop production. Forecasts this morning, both the Euro and the GFS are dry for the next 7 days. 1 to 7 day GFS, our friends at Crop Profit, based on that model, would imply that U.S. corn areas will see only 51% of normal rainfall over the next 7 days. You go to the 1 to 7 day Euro, 53% of normal rainfall expected for U.S. corn areas. So dry pretty much across the board here for a lot of areas. 8 to 14 is where we've got a big discrepancy in the model. The GFS this morning stays dry, only half a normal rainfall expected for U.S. corn areas. But then you go to the Euro, and 97% of normal rainfall expected during the 8 to 14 day period. So you've got a big divergence between the GFS and the Euro as it relates to the 8 to 14 day period. But guess what? It's getting kind of late, and pollination is ongoing in a lot of areas, and this heat's going to stick around, and the dry conditions going to stick around for a little while. So the 8 to 14 day, I mean, even if it cools off, I feel like there could be some damage done before the time that it does cool off potentially. Temperatures warm, especially in the northern plains and in U.S. spring wheat areas. Spring wheat areas, look at that, 7.4 degrees above normal is what's expected based on GFS data over the next 7 days. This morning, the Euro is similarly warm, but for different places over the next 7 days. It spreads more into like the Western Corn Belt and even parts of the Central Corn Belt. Looking at the 8 to 14 day GFS, super warm this morning. U.S. corn area is expected to be 6.3 degrees above normal. And then the Euro is much cooler, only 2.2 degrees above normal for U.S. corn areas, 8 to 14. So there is some divergence certainly in the weather models this morning. But it looks like for the next week at least, it's hot and dry, especially northern plains, Canada, places like that.
If you guys have not checked out our premium content, you sure need to do so. Joe, can you tell our viewers about some of our most recent videos?
Matt Bennett was on yesterday for a 20 questions mailbag segment. In these videos, Matt and I run through a list of mostly 20 questions, 20 give or take, about grain marketing that come in from our premium subscribers. And it's grain marketing, it's USDA, it's corn yield prospects. One of the big topics we covered yesterday is corn. X yield equals Y carryout. How exactly does USDA do this? We had a really great chart and some cool kind of information on how USDA actually does this early in the season. But if you're looking for some like topical grain marketing information, this is what we talk about. These are like 30 to 35-minute episodes. And, all the premium stuff, of course, is uncut, commercial free, not interrupted. It's really great. Matt is one of our favorite guests, of course. Andre Sizoff was on earlier this week. Is wheat underpriced? Yeah, it was when we made this video. And Andre is an analyst out of covers the Black Sea. I think he's in Spain, but he's Russian, and did a fantastic job of telling us kind of what's going on as it relates to Russia, Ukraine this week. And this was all before the big rally. Our stuff has been so timely and topical lately. It's I can't call them and play them any better than what we've done here the last couple months. The Brazil versus U.S. production cost study from National Corn Growers. We had Krista Swanson on Friday last week. She was fantastic. Ryan Moe talked with me about overnight temps at corn yields as well as basis spreads, all that stuff. If you want to see the premium stuff, guys, go to standardgrain.com. You can sign up this morning. This is a $50 per month subscription. You can cancel at any time. No other fee, no other obligation. Nobody will try to sell you anything else. You want to be on our email list. You want to be on our text list. If you are the decision maker in your farm operation, this stuff is absolutely vital. Give it a shot this morning.
NOPA released its June crush data yesterday. The U.S. soybean crush increased compared to May as NOPA members processed 214.34 million bushels. Crush was up 2.7% month over month and up 16% compared to June of last year. Additionally, last month's crush was the highest on record for the month and also exceeded all trade estimates. End of month soybean oil stocks fell to an 8-month low of 1.5 billion pounds, down 13% from May, but up 8.5% compared to last year. Stocks fell below all trade estimates, which averaged 1.65 billion pounds.
Hey, you want to know why I wear a hat all the time? Do you want to know?
Yeah.
It's because I have outrageous hair. Like my hair is outrageously thick. And I just can't deal with it every day.
Should we cut that?
Much. It's too much. So I won the hair lottery Like I'm
Yeah,
42. I'm 42. I'm not bald. I have no gray hair. Like I won the lottery. Like I should be very proud of what's going on here. It's just it's such a pain in the ass to deal with that I don't mess with it on a daily basis. Okay, so NOPA crush volumes absolutely fantastic. We're crushing just an outrageous amount of soybeans. It's really fantastic. It's helping to offset the crappy export program. And the export program is crappy because China hasn't been buying U.S. soybeans in the way that they typically do. Although I think you'll see some flash sales reported possibly this morning, as I mentioned. The split as it relates to demand for U.S. soybeans looks like this. Domestic crush, what we're talking about here, is going to account for a ballpark 61% of all demand for U.S. soybeans this year, where exports are going to be only 37%. Historically, in the like, call it 2015 through 2020-ish time frame, it was kind of like a 50-50 split. And now we're moving, because of mandates, essentially, we're moving much more toward like a domestic crush led demand scenario rather than relying on exports. We're trying to kind of wean ourselves off of reliance on China, which is going to take a while. And we're not there yet, but we're moving in that direction. Crush margins have weakened, but are still historically excellent. 302 on the board, but cash crush margins are like $4 to $5 per bushel in the Central Corn Belt. So all is well and good here.
U.S. ethanol production fell to a 10-week low last week. Weekly output was reported at 1.04 million barrels per day, down 4.8% compared to the prior week and down 4.1% versus the same week last year. Ethanol stocks climbed to 24.39 million barrels. The print was up 1.9% compared to the previous week and up 1.8% versus the same week last year. According to Reuters data, U.S. ethanol margins range from 10 cents to 35 cents positive across the Corn Belt.
I wonder, we won't be able to see it, but like when the ethanol plants end up with this 45Z tax credit, you won't see it reflected in like the calculated margins, but they're going to make so much damn money. And I hope the farmer gets to participate. I'm skeptical that they will, but we'll see. What did cattle do yesterday?
Cattle futures were lower once again. Live cattle were $1.30 to $2.83 lower. Feeders saw losses ranging from 48 cents down to $2.80, with the exception of the front month contract, which gained $1.15. Box beef prices were also lower. Choice was down $2.67 at $371.28, and Select was down $5.23 at $359.18.
Outside market's pretty quiet this morning. The S&P is down 10. Crude oil is about flat, 79.56 last in the August WTI. Guys, have a great weekend. I'm off tomorrow. Mackenzie will be here with Matt. I'll be somewhere wearing a hat, I would imagine. See you guys later.